Mae Fuller. She was the first recipient of monthly Social Security benefits. She paid $24 into Social Security, and over her lifetime, she received over $23,000 in Social Security benefits. And now you know why Social Security is going through the problems that it is. One question I receive all the time is, Karen, will Social Security be there for me for the rest of my life? And the answer is, it depends. If you're 65 or older, you have nothing to worry about. Social Security, depending on which year you're reading that Social Security's trustees report, it's going to be fully funded for the next 25 to 30 years. So if you're 65 and you are alive 25 years from now, God bless you. For anyone under the age of 55, it's going to change. I have no idea how it's going to change, but my hope is that we receive at least 70% of our promised benefits. And for anyone between the ages of 55 and 65, I am 98% sure that you will receive all of your promised benefits for the rest of your lives. And the reasons why I say that, number one, you are the largest voting population. And now your children and your grandchildren can vote. And if Social Security was changed in such a way that you're losing some of your promised benefits, there's a good chance that politicians would not be reelected. And from what I understand, politicians like their jobs. If you don't believe me, ask Eric Cantor. Number two reason. People are worried about what happens if we hit a financial crisis, like what happened in Greece, Italy, Portugal, Spain. If you look at what happened in those countries, yes, they reduced their spending, they increased their taxes, but the one thing they did not touch was the pensions to the elderly. And the feeling is the U.S., we do care about everyone, and we would protect Social Security for anyone who is currently receiving it. And finally, the third reason, the Congressional Research Services came out with a report, and it said of all of the options before Congress to reform Social Security, all of them are protecting benefits for anyone over the age of 55. That's my theory. You may have something else, but that's okay. So Social Security, as you all know, its Social Security benefits are based off of your full retirement age. Your full retirement age starts at 66, or 65 for some people, and gradually increases to 67. Take a look at this, find your full retirement age, but for purposes of making this whole presentation easier to understand, we're going to assume a full retirement age of 66 because that's the full retirement age for everyone retiring between now and 2020. The only thing you need to know about Social Security is that the answer to any question that begins with before 66 is no. If you do anything before 66, there's nothing but reductions and penalties, and you cannot do anything special if you apply for Social Security before 66. With that, you could literally get out of the room right now because you've learned everything you need to know about Social Security. All right, so for example, if you take Social Security before 66, your benefits are going to be reduced. So if you take at 62, you are going to receive the least amount that you possibly can from Social Security. After 66, your benefits grow by 8% per year. This is on top of any cost of living adjustments. Another reason for taking at 66. After 66, you can work as much as you want and receive your full Social Security benefits. If, however, you are under the age of 66, working and collecting Social Security, your benefits are further reduced by $1 for every $2 that you earn over $15,720. Now, this is an individual limit. So if you're working and you're married and your spouse is working, the administration only looks at your income, but make sure when you apply, you tell them your income so that they have that record and they can compare it against the IRS records when they receive it. This reduction only applies to your income from working. So you can have as much income coming in from your dividends, from rents, royalties, from your 401ks. They only care about your income from working. How this works. Let's say you're 64 and you retire in June. So when you apply for Social Security, they're supposed to ask you, how much have you made up until this point? And you're going to tell them, I've made $50,000. They are supposed to put that in because you can earn as much money as you want up until you start taking Social Security. It's only when you take Social Security and you are under what age? Age 66, that this reduction applies. So then when you apply in June, you're 64, you tell them you've made $50,000. What they're going to do is for the rest of the year, they'll take that $15,720 divided by 12, which gives you that $1,310 per month. So from June until the end of the year, they're going to take that $1,310 and multiply it by the remaining months of the year, and then say that's how much you can make for the rest of the year. So if you retire in June, that's about $7,000, $8,000 that you can make. And then going forward in 2016, it applies to any benefit, to your benefits. Now keep in mind, this reduction applies to any Social Security benefit you receive, whether it's your personal benefit, your spousal benefit, your divorcee benefit, and your survivor benefit or your widow benefit. So what this means, if you're under the age of 66 and working, should you take Social Security? The answer to any question that begins with before 66 is no. So then the question becomes, what happens when I retire? Or what happens when I turn 66? Should I take Social Security or should I let my benefits grow? And that's where we use the 4% rule. It's just a general rule of thumb which says if you can live off of less than 4% of your assets, then you should let your Social Security benefits grow. If, however, you need more than 4% of your assets to live off of, then you probably should take Social Security. I'm sure that Mary, Kim, Emily, Scott, everyone else in the room here would agree with me. We are much more interested in making sure that your personal assets last your lifetime than in making sure that you receive every single dollar from Social Security that you possibly can. And that's where the 4% rule comes into play. It's my understanding that Raymond James, Mary, and her team, they have a great software called Goal Planning Monitor. And what that does is it compares how your Social Security claiming decision will impact whether or not your assets will last your lifetime. So that's something you definitely want to talk with Mary and her team as you decide when should I take Social Security. We decided to see, okay, so what this slide shows right here is if you took Social Security at 66, let's say you were supposed to receive $1,000 per month. If you took at 62, you'd receive $750 a month. If you took at 70, it's $1,320. Just because with $1,000, the math is really easy to understand. So what we wanted to do is see how, if you took Social Security at those ages, what would you get if you used it for rent in the most popular retirement community in all of the US of A, which is, everyone wants to retire in Asheville, North Carolina. So here's what we found out. If you took at 62, you get a nice one-bedroom apartment. If you took Social Security at 66, now you get a 2-bedroom house. It's a little bit older. And if you took Social Security at 70, it's a nice 3-bedroom, 2-bath, brand new home in Asheville, North Carolina. What we're trying to show you is that when you claim Social Security may impact how you live during retirement. There was a study that found that waiting 1 year to retire increases the chance that your personal assets last your lifetime by 17%. Waiting 2 years to retire increases the chance that you'll have enough assets for your life by 33%. And waiting 3 years to retire, it's a 55% increase in whether or not your assets will last your lifetime. So it's much more important to decide how long you're going to work than when you're going to claim Social Security, because you're working, and when you decide to retire, will determine whether or not your assets will last your lifetime. All right, let's talk about options for couples that have been married. So what I'm about to say also applies to anyone who has been divorced and married for at least 10 years. So, Social Security. In order to make this whole concept easier to understand, I'm going to assume that the wife earned less than her husband's. And that's because according to the Bureau of Labor Statistics, female baby boomers earn less than their husbands. Now, the Bureau of Labor Statistics is predicting that I'm going to earn more than my husband over our lifetime, And to be honest with everyone, I'm kind of hoping that's not the case because I prefer to spend my husband's money. I don't want him spending my money. So here's how it works. The wife can receive up to 50% of her husband's benefit as long as she is what age when she first applies for Social Security? Age 66. If she applies for Social Security before 66, is she entitled to 50%? The answer to any question that begins with before 66 is no. So she can receive a reduced spousal benefit as early as 62, but then she's only going to receive 35% of his benefit, not 50%. The spousal benefit is always going to be based off of her husband's age 66 benefit, regardless of her husband's age when he claims Social Security. So for example, we're skipping ahead. Here we have Dan. Let's assume he's going to receive $1,000 per month. So what we're trying to see here is what would happen if Dan would take Social Security at 66 or 62, or if Laura would take Social Security at 66 or 62. How much would they receive if his benefit at 66 was $1,000 per month? Well, if he took at 66, he would receive $1,000 per month. If she was 66, she would receive 50% or $500. Now, we're not going to show this on the chart, but if he was to receive Social Security at 70, he would receive $1,320. If Laura was 66, would she receive 50% of his age 66 benefit or 50% of his age 70? So would she receive $500 or half of $1,320? $500. So all spousal benefits are based off of his age 66, regardless of his age. I think it's getting a little hot in here. Can we turn down the temperature a little bit? Thank you. All right, so here's another important rule of Social Security. Once both spouses are age 66, someone should be taking the spousal benefit because the spousal benefit does not grow after age 66. So once both spouses are 66, someone at a minimum should be taking a spousal benefit because otherwise you are giving up free money. Now let's say he was 62, let's say he was 66 and she was 62. Would she be entitled to 50% of his benefits at 62? No, she would only be entitled to 35% if she claimed at age 62. So she would receive $350, he would receive $1,000. He's 62. So he's going to receive $750. She is 62. Will she receive 35% of his $750 or 35% of his age 66? His age 66. So she's going to receive $350. He's going to receive $750. He is 62. She is 66. Will she receive $500, so half of it age 66? Or $375, half of his age 62? $500. All right, so another rule we have with Social Security is that we will let the lowest earning spouse do whatever he or she wants as long as it means that the highest earning spouse is letting their Social Security benefits grow for as long as they possibly can. So let's just assume that Dan is actually the lowest earner. We will let him claim at 62 if it means that Laura, let's say she's the highest earner, is 66, so that maybe she can start off with the spousal benefit because that spousal benefit is always based off of his age 66, regardless of his age when he claims Social Security. Now, some important rules about the spousal benefits. If you're married, only one spouse at a time can claim a spousal benefits. You can't have both spouses claiming it at the same time. Only one spouse at a time, if you are married, can receive a spousal benefit. Also, in order for the wife to receive a spousal benefit, her husband must have applied for Social Security. If the husband has not applied for Social Security, the wife cannot receive a spousal benefit. And if both of you worked, you generally receive the greater of your personal benefit or your spousal benefit. We'll get into some differences later on in the presentation. Now, after the husband passes away, hate to break the news to you gentlemen in the room, you're statistically supposed to pass away before your wife. And I don't know if that's a blessing or a curse for us. So after the husband passes away, assuming he's the highest earner, his benefit becomes the wife's benefit. So she will usually step up to the amount he was receiving after he passes away. So after he passes away, the wife receives the higher of her current benefit or the husband's benefit, which means for the highest earner in the couple, your benefit is no longer your benefit. It's the couple's benefit. And your Social Security claiming decision is going to impact how your wife lives after you pass away. So here's a tough love scenario. And I'm using the tough love because I have 4 brothers, and I have found that for some reason men listen to me a lot better when I give you tough love than when I'm nice to you. So here's a tough love. A lot of times the husbands come up to me because they're typically the higher earner, and they say, Karen, when should I take Social Security? Because I paid into it. I want to get as much from Social Security before I die. It's all about me, 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 me. Here's the thing. I do not care about you as an individual. I care about you as a member of a couple. And yes, I do realize that if you take Social Security at 66, 68, 70, however long you decide to let Social Security grow, if because you did that, yes, there is a higher chance that you could pass away before you receive every dollar from Social Security that you paid into it. But if because you let your Social Security benefits grow, if that gives you peace of mind that you did everything within your power to make sure that your wife received the highest source of guaranteed inflation-adjusted income for the rest of her life, maybe it's worth the wait. That being said, if you don't like your wife, definitely take at age 62 to make sure she receives the least amount possible. All right, what if you are divorced? If you are divorced, basically the same rules, the same calculations as what we showed you before. If you are divorced, you're entitled to benefits off of your former spouse as long as you were married for at least 10 years, and generally as long as you did not remarry. So then the question becomes, what if my spouse remarries? If your spouse remarries, that does not affect you. If you, however, remarry, you generally forfeit the benefits off of your former spouse. So let's go through an example. Robert Redford was married to his first wife for 30 years, divorced her, and married a younger woman. So Social Security is paying benefits to Robert Redford. His first wife is receiving a spousal benefit because she never remarried, and his current wife is also receiving a spousal benefit because she is currently married to him, and no one's benefit is going to be reduced. Let's do another example. Jane Fonda. Jane Fonda was famously married to Ted Turner. In my story, they were divorced. They were married for 10 years, got divorced. Then she married a rich Texas millionaire, stayed married to him for at least 10 years, and then she divorced him. So when she applies for Social Security, assuming she is what age when she first applies for Social Security? Age 66. See how easy Social Security is? So assuming she's 66, she can decide if she wants to receive her benefit, half of Ted Turner's benefit, or half of the rich Texas millionaire's benefits. Very nice for her. All right. Next section. Okay, James and Linda. Let's see how Social Security benefits are calculated for married couples. James and Linda, the reason why they're named James and Linda is because it was the most popular baby name every single year from 1947 until 1954. So if any of you are named James and Linda in the crowd, we kind of know how old you are. All right, so for James and Linda. So James, he's trying to decide, should I take Social Security at 66 or 62? My wife never worked. If he took at 62, he'd be receiving $13,500 a year. If he took at 66, it's about $18,000 per year. When you add in the spousal benefits, it's a difference of over $7,000 per year. Could an extra $7,000 a year make a difference in how some of you live during retirement? Does anyone know the cost of health care during retirement? For a married couple, if you're in good health, it starts off at about $7,000 per year. Once you start needing lots of drugs, doctor's visits, etc., you're easily looking at $14,000 per year. So by taking Social Security and letting those benefits grow until 66 or whatever, it may help to offset some of those higher costs of health care that you may experience during retirement. What if both spouses worked? Well, here we have Robert. He's going to receive $1,500 a month. That's about the average male benefit for Social Security. His wife is going to receive $900 because her benefit from working is greater than half of her husband's benefit, and the administration will always try to give you the higher of the two, for a grand total of about $2,400 per month. All right, let's look at another situation. I'm sure some of you may have heard of some of these switch-up strategies where you can start off with one benefit and then switch to another benefits. Guess what age you have to be when you first apply to be able to do any switch-up strategy? Age? 66. Very good. Do you think that if you apply before 66, you can do a switch-up strategy? The answer to any question that begins with before 66 is no. If you apply before 66, the administration will automatically give you the greater of your reduced personal or your reduced spousal benefit, and you are locked into that amount for the rest of your life. You can only do a switch-up strategy if you first apply for any benefit at age 66. So let's go through an example here. John is going to do something called file and suspend. The reason why John may want to file is so that his wife can receive a spousal benefit, because if he doesn't apply, his wife cannot receive a spousal benefit. This illustration we're going to use right here is for the situations where the lower earner's benefit, personal benefit from working, is either going to be lesser or equal to the spousal benefit. So if you're a couple and you are the lower earner, if your personal benefit is going to be less than the spousal benefit, this is the situation that we're going to look at right now. This is the one for you. So John's going to apply at 66, so that because he applied and then he's suspended, he's not going to receive his benefit. But because he applied, it allows his wife to receive the spousal benefits, because those spousal benefits are going to be greater than her personal benefit. So she's going to receive that. It's going to stay about the same amount. His benefits are going to grow by 8% per year, and at 70, it's going to start automatically. When he turns on Social Security, her spousal benefits will stay the same amount. They will not step up. This is a great strategy for the husbands who realize, you know what? I should really take Social Security at 70 because I really want to maximize the benefit for my wife regardless of what happens to me. But yet I want to utilize some of my Social Security benefits. File and suspend so that your wife can receive the spousal benefits off of you, which is greater than her personal benefit. Let me use a real life scenario. My husband and I got married about, let's say, I'm still going to say it's a year and a half. It's approaching 2 years now, but I like to pretend we're newlyweds. So my husband and I got married, and before we got married, we went to meet with my pastor to see if he would marry us. I'm Lutheran, my husband's Catholic. As some of you can imagine, this is a very big deal. So as we're talking with the pastor, he happened to let me know that he turned 66 3 weeks before. So being the good Lutheran girl I am, I asked Pastor, what do you plan on doing for Social Security? And Pastor's all proud of himself. He's going to take Social Security at 70. And I said, Pastor, that's wonderful. But what about your wife, Daria? Daria's 62. Yes, she worked, but her personal benefits are less than her spousal benefits, and she stopped working to take care of her mother. So I said, Pastor, what you really should do is file and suspend so that your wife can receive the spousal benefits. It's greater than her personal benefits, and she's receiving this 4 years earlier than what she planned, because she thought she was going to take it at 66. Pastor loved the idea. He's using her Social Security benefits, or that spousal benefit, to pay off the mortgage so he can retire debt-free. And best of all, after I explained this to him, he had no problems agreeing to marry us. But we still had to make the donation. All right, so now let's look at the situation where both spouses worked and they have similar Social Security benefits, meaning that the lower earner's benefit, personal benefit from Social Security, is going to be equal to or greater than the spousal benefit. So if that's the situation where you're the lower earner and your personal benefit is going to be equal to or greater than your spousal, this is what you're going to look at. So in this case, we have David. His benefits at 66 would be $2,000. His wife's benefit from working would be $1,500. Now, for the average married couple, you're looking at about, I would say, 81 to 2,000 different options for claiming Social Security, depending on who you're talking to. We've narrowed it down to just the 3 most popular options. Option number 1. Everyone takes their personal benefit at 66. So David retires, he starts his Social Security at 66. What's her name? Susan retires, she starts her benefit at 66. After David passes away, because his benefit is higher, Susan receives that amount, the higher of the two. Let's look at another example. When Susan is 66, she applies for Social Security. Because she applied, it means that David can start off with half of her benefits. So David's going to start off with half of her benefit. Then when she applies, or I should say, then when he turns 70, he switches over to his benefit. She still receives her same amount because her amount was greater than half of the spousal. And after David passes away, she receives his benefit. Then the other option, when she turns 66, David's going to file and suspend so that she can start off with the spousal. When he turns 70, he turns on his benefit. When she turns 70, she turns on her benefit. And after he passes away, she receives his benefit, which is the higher of the two. Now, the only reason why they had these different options for starting off with the spousal and then switching is because they were what age when they first applied for Social Security? Age 66. If they had tried to do this before age 62 or before the age of 66, could they? No. You can only do the switch-up strategies where you start off with a spousal and switch over to a personal if you are what age when you first apply? It's age 66. All right, so when it comes to taxes, once you start collecting Social Security, the government, those Social Security benefits could be added on to your current income and could become taxable once your income exceeds $25,000 if you're single, $32,000 if you're married filing jointly. Now, the IRS is always looking for money from you, so they don't care about your age. Regardless of your age, when you claim Social Security, they're going to try and tax your Social Security benefits. And basically, all of your income is included to determine whether or not your Social Security benefits are taxable. They use something called a combined income. So what this means is they use your AGI, which is lines 1 through 37 of your tax form. So they're going to include your earnings, your 401k withdrawals, your IRA withdrawals, your rents, your royalties, capital gains. They're going to use all of that. They're also going to include any municipal bond income, but they're only going to use 50% of your Social Security benefits. So for most Americans, the crazy thing is the more you can rely on Social Security for your retirement income, the less chance that your Social Security benefits will actually be taxable. We did a case study where we looked at 2 couples, both having $50,000 in pre-tax income during retirement. One took at 62 and one took at 66. The couple that took Social Security at 66 was able to reduce their taxes by 50%. Because only 50% of their Social Security benefits were included and were taxable. So sometimes allowing your Social Security benefits to increase may actually reduce your taxes during retirement. Another thing to keep in mind is that there are some items that are excluded from this list, meaning they are not counted towards your income, so therefore they will not bring your income up, which means there's a less chance that your Social Security benefits will become taxable. So some of these items include qualified distributions from an HSA, from a health savings account, life insurance proceeds, what else we have? Inheritance gifts, or more interesting, any distribution from a Roth IRA or Roth 401k. So having this Roth may help you control your taxes during retirement. So if you have a Roth, it changes the discussion from do you want to take from your traditional IRA first or your Roth IRA to what's the right amount you want to withdraw from both to really minimize your taxes in retirement. That couple that took at 62, by just taking a sliver of the withdrawal from a Roth IRA, they were able to reduce their taxes to absolutely nothing. So if you don't have a Roth IRA and you have a traditional IRA, you want to do a conversion, we recommend that you do the Roth conversion by the time you are 62 because your Medicare Part B premiums are based on your income from 2 years prior. So therefore, by the time you're 62, that's when you really want to start maximizing your income. Once you're 63, you want to find ways to minimize your outside sources of income so that the only income they're looking at when you apply for Medicare is your wages. Another way to get Roth, just so you can control your taxes during retirement, is if you're still working and your 401k plan or your 403b plan has a Roth option, maybe take some of your pre-tax contributions and shift it to a Roth. Even if it's only 1 or 2%, just doing a little bit so you have that flexibility later on in retirement to control your taxes may be helpful. For example, when people retire, what's the first thing people usually buy when they retire? A brand new... Toys, yes. Cars, let's say cars. Most people buy a brand new car. If you took that, if you pay for that car from your traditional IRA, let's say it's a $30,000 car, after you pay for your state taxes, your sales tax, all of that stuff, you pay the withdrawal because you just withdrew $30,000 from your traditional IRA. That $30,000 car is probably now $36,000 after taxes if you took it from a traditional IRA. However, if you withdrew that money from a Roth, it's now only a $36,000 car. So therefore, it's a really good discussion to have with Mary, Emily, and I can't remember everyone else on the team I met today. Emily. There's a lot of people on teams who can help you sit down and realize ways like how can we restructure my assets when I start retirement and up to retirement to really make sure I pay as least amount as possible during retirement. So when you apply for Social Security, you can do it 3 ways. You can do it in person, online, or via the telephone. If you want to do it online, my recommendation is only do it right now if it's only for yourself and you're not married, because you don't want to mess it up and thereby mess it up for your spouse as well. If you want to call them, the best times to call them is Thursday and Friday nights between 4 and 7 p.m. Eastern Standard Time, because everyone else is doing something better than calling the Social Security office and you will get through. Also, if you want to do some of these spousal switch-up strategies, my recommendation is that you go in 1 month after you turn 66. At the very minimum, make sure you do not say that you want your benefits to start in the month that you turn 66, because they start calculating your Social Security age 66 benefits after you turn 66. So if you said you wanted your benefits to start in the month that you turn 66, and then you said you wanted to do a switch-up strategy, they're going to say it's not available to you because in their mind you have not yet turned 66. So if you want to do a switch-up strategy, apply at age 66 in 1 month, just to make the whole thing a lot easier. So with that, that's my general rules of thumb. When it comes to Social Security, if you're married, we care more about both spouses than we do about you as an individual. So take into account the longevity of the longest living spouse. The 4% rule is a nice rule of thumb for determining should I take Social Security or let my benefits grow. And the most important age to remember is age 66. And the answer to any question that begins with before 66 is no.
That concludes this episode of the Advantage Series. If you have any questions, please call 530-272-7500.